Starting with you, Brian.
Sure. Hi, my name is Brian Hung. I'm from APG Asset Management, a Dutch pension fund asset manager. I cover Asia Pac and have been looking at the PBSA sector, specifically in Australia, for the last 5 years. And yeah, I mean, I think it's definitely one of the up-and-coming niche sectors that people should be looking at.
Great. Ben.
My name's Ben Hall. I'm the head of investments for Q Investment Partners. We're a Singapore-based fund management business. We invest into the UK student accommodation. We've actively looked into Australian student accommodation and haven't done it for certain reasons we can discuss today.
We certainly are. Emily.
Hi, Emily Fell. I'm currently based in Singapore, have been for 5 years. I cover Asia Pacific in terms of outbound capital. Previous to that, I was with Knight Frank's student accommodation team in the UK. Since being here, I've specialised in working with Asian investors, helping them invest into student accommodation and other specialist sectors in the UK, Australia and the US.
Hi guys, my name is Eugene Mack. Well, thanks for being here today. I run a company which is called Rosebery Capital. It's a multifamily office equity platform that invests in mainly now in the UK student markets. We've built a portfolio over the past 5 years where we've bought the site and developed them and now operate them. We'd like to, going forward, scale up our portfolio in the UK. We mainly look in London and peripheral London in terms of location. Thanks, guys.
Excellent. As always, questions welcome at every opportunity. We're going to start off fairly macro, then we're going to drill down looking at operating models, key investors in the sector, then we'll sort of go down a bit further, take a look at Australia and the UK, where the current hotspots, and then we'll finish up on the changing nature of student accommodation. Emily, I'd like you to answer the first question. Where are we seeing the biggest potentials for growth for PBSA in Asia?
Okay, so yes, in Asia, very interesting. We've been used to a lot of discussion about the US market, UK market, both very mature at this point. We think it's really interesting looking to Asia now because we're seeing a big change in hierarchy. So we're seeing Chinese and Indian universities going up the rankings of global universities, and actually some of the traditional universities dropping off a little bit. So whilst overseas students into UK and US have been driven by Asian students typically, we actually might start seeing domestic students in Asia staying in their home countries, which is going to be really interesting for first movers in this region to look at the sector. So India and China in particular are very interesting markets for those looking further at the risk curve and looking to get an initial footprint. Of course, Australia in Asia Pacific's a well-trodden market. As Brian will talk to you later on, probably in more detail. It's quite a different sector to the UK in that the demographics are quite different in terms of the split between international and domestic students, but still one that we're going to see grow into a lot more of a mature market and see much more transaction volume coming through.
Yeah. As a thought, I mean, as we see in Indian, Chinese students stay in country, is that going to have an effect on them going overseas? Are we going to see less Chinese students overseas and them staying in China and the same with India?
I think this year we've seen a very, very slight, 0.1% drop off in terms of Chinese students travelling overseas. The effect is going to be very, very small kind of in the short to medium term, but I think long term it's something we're looking very, very closely at. But we're still seeing in the UK, for example, 9% increase of international students year on year. So that's really strong. We're not really seeing Brexit as a big issue for the UK student market. The only issue might be, and Eugene, you'll probably know more about this, but might be the drop-off of European students. But actually they make a very small proportion of international students in the UK, so not a huge impact.
Okay. Any questions off the bat? No? Okay. Ben, so I mean, you're an investor in this sector. What do you look out for when deciding to invest in a PBSA?
Well, we're invested into the UK, so basic fundamentals of real estate investing. We're looking to develop a building to get 20% minimum profit on cost. So to do that, usually we need to be into a top-tier university market in the UK, there's 77 student markets. We've got 15 target markets within that. Most of them either have a Russell Group university or a Russell Group university and then a Polytechnic university. So student number somewhere around 25 to 50,000. And the buildings that we're building are sort of 200 to 400 beds. So really, it's quite simple. We're just trying to find a good location, 200 to 400 beds. We want to get 100% occupancy in year one. And then we just got to make sure that the supply and demand dynamics are correct. So we work very closely with our operator, with our developer, and our developer is our contractor as well. So we're vertically integrated up from the people with the shovel. And then from there, we're making sure the costs are right. So, you know, if you're thinking about a development appraisal, we're making sure the building values at a certain level because of the supply and demand dynamics of the local market. And then importantly, we're developing, so we've got to make sure the costs are right. So we're able to get sort of a fixed price contract for a development when we buy land, which is a sort of major advantage within student accommodation at the moment because there's a lot of buildings opening late. If you open a building late, you probably just lost all your profit on day one. So we know from experience based on that. And that's really just our cookie cutter model now across the UK.
Yeah.
And so just to add, I guess, one point, I think the operating aspect of student accommodation is also quite key. For us, we hold long-term, 7 years minimum, and therefore, you know, apart from, you know, what Ben had said on the development side, you know, choosing the right operator is very important, as I think we'll be discussing a little bit more in the later segment. The student accommodation sector is definitely changing. It's not just giving a room, it's creating a community, creating events, and having that pastoral service, pastoral care element of the entire product, which is very important.
Yeah. Just touching on operating models, it's more than just leasing to a university, though, isn't it? I mean,
Correct, yeah. So there's three models that we see in the UK. One is a lease to a university. I guess you can look at it like a triple net lease. So your risk is just completely connected to that university. So you're looking at the covenant of the university. And then you'll get some cap rate compression because of that. The next is sort of a nomination agreement. So this is, you know, revenue guarantee. So you're really removing any risk of occupancy. And then you've got cost risk only that you're managing. And then the next, which most of us do, is direct let, which is basically employing a third-party operator or owning a third-party operator, and then they let to students, which is basically the bulk of the market. The nomination agreement and the lease, it's like hen's teeth. You know, no one can get these sorts of deals until your building is about built or has been operational, because there are plenty of pesky investors and developers in the market trying to knock on their door all the time, asking them if they would like to sign that agreement, like a pre-commit before you've broken ground. So they don't want to speak to people like Eugene and myself earlier on. So they just wait until the building's built to sort of offer those agreements.
I suppose relevant to that, there was the change in the London plan, whereby London's been very restrictive on student development, and recently said before you build a student development, you need to have an agreement with the university. They've actually just over the last week retracted that because they said it was too restrictive. But we might see more of these sort of things coming in, just to make the planners just making life a bit more difficult for these guys.
Yeah, I guess we're finding it quite tough to go into these leases with unis. And now, as I was having a meeting with one of these large universities, accommodation manager, a few months ago, and they were no longer taking on any new leases, you know, because obviously funding and balance sheets are a lot more constrained in the UK. And we are at the moment focusing a lot more on direct let models. And you actually see the yields between direct lets and leases, you know, converging a lot more than before. So you know, we try to make the best out of direct let models where, you know, you arguably get a slightly higher rent by taking on the tenant risk. And our company, sort of being positioned in Hong Kong, tries to sort of capitalize on Chinese students. I'm not sounding too politically correct, but Ben and I were having a competition on whether we've got the worst students in our schemes, but I think Chinese students are the best students because all the other students throw parties in their rooms, but Chinese students go back to their room, play with their phones. They'd rather text someone in the next room than go to meet them, and that's it for the evening. So from a operating
and they're paying up front most of the time. So
exactly, yeah.
They're paid up front before they've moved in. Well, their parents are paid up front, which a lot of people forget. They think they've got some struggling student working at Sainsbury's trying to pay their rent. Mum and dad paid that well in advance. So paying for issues as a tenant, well, you don't really care in the end because there's a good deposit. They're paid up front, and from there you can kind of fix it.
So I think the profile of the students is one of the things that makes a scheme a success.
Yeah. And you target a specific profile when you start. So you say I'm going to target specifically Chinese students because the money's up front.
Yeah. I can't say for the rest of the panel, but we certainly try to look at that. We're in several sectors in addition to students, and we try to recognize that the Chinese inbound or outbound into the UK is a driving force for, in general, real estate demand. So we try to capitalize on that.
Just to play devil's advocate to that, Eugene, we've been marketing a portfolio in the UK over the last few days here, and there's been some concern that the government in China could start to regulate students leaving China because they realise if someone is a graduate somewhere, they're more likely to stay there and work there. So they want to keep them more inbound. Do you see that as a risk or not?
Yeah, I think no, definitely see that, and it's the visas are more restrictive and so on. But I guess on a relative basis, you see the same problem happening in a lot of other countries as well. So US is obviously tougher to get into now. And you go back to the value of the pound, right? So it's so low that the cost of a degree is 30% cheaper than in the US. So a Chinese parent who is on a budget would go for the UK still when you look at UK, Aus, and the US, I guess. Yeah.
I think one of the things we've seen, definitely in Australia as well, I would say on average probably 50% of the PBSA product is the customers are ultimately Chinese, but the operators indeed see that as a risk. And so what we're seeing is a lot of them trying to diversify, including the university as well, trying to diversify the customer base, setting up maybe sales offices in Southeast Asia, India. So we're seeing some growth in the Southeast Asia market coming to Australia as well.
I think that's why it's affordability is quite an issue in the UK, isn't it, Ben? Because all the products that's been built over the last few years has been very high end, and it's important to counter for domestics as well.
I wish we could put 5% rental increases in all our models because we'd be hitting all our hurdles very quickly, but the probability of that in key markets is very low now. You're lucky to get 2 to 3% in some markets, which is actually a good thing because the market's matured. If you're getting rental increases of 5, 10, 18%, whatever, it's just an immature market and people had a first mover advantage. So if we're going in with the consistent 3%, well, it's just a mature market. So we kind of see that as the market de-risking to a perspective. But in some markets, that's going backwards. So other markets, like Liverpool, I think, was oversupplied. But in a lot of these markets, it's because the town planners have got a very easy rubber stamp. They're pushing approvals through very quickly. And then the supply is pumping up. Rentals are going backwards temporarily. But that's kind of just the dynamics of any real estate market. Supply and demand, and then you've just got to monitor that. Other markets like Edinburgh, no one wants to stamp a planning approval, so rental growth is really healthy. Student demand goes up, rental growth is healthy. But there's so many markets to look at in the UK that if one's bad, you've got another 76 to look at. And we constantly get branded, all of the UK gets branded as, it must be oversupplied now because everyone's in it. Which one of the markets are you talking about? And even if a market's bad now, it will come back in a few years anyway if the right dynamics are in place.
Yeah, and I guess speaking from a sort of family office perspective, I remember 5 years ago when we brought schemes to families, and we had 2 schemes, one in London, which was yielding at 5.5%, and another scheme which was in Leicester, which was yielding 7.5%. They went for the higher yielding structure. We sort of argued that you also look at capital appreciation aspects, which were more far-fetched for the family in terms of whether you actually get that.
Where's the family from?
Well, Hong Kong. And so they would rather look at the money they have now, which is 7.5. I'm getting 7.5%. I'm investing in fixed income, which is giving me 5%, 4%. There's a pickup, but then a lot of these guys will think a bond will give you a capital protection at the end of your term. You get your $100 back, but there has been a few. Real estate is different. There is no capital protection mechanism when you actually sell. You don't know how much you're going to sell the scheme for, or you're going to be valued at. And there were some disappointments where you yield 8%, but you lose your value over time, and you don't actually net 8%. So a lot of emphasis on the headline yield, but I think that there needs to be a bit more balance on how you look at a scheme.
Great. Any questions? Randy? Can I have a... Yeah.
On the there's a panel discussion earlier today on investment into real estate in Canada, and one of the frequent conversations anyway was around student housing in Canada as well. Of course, there's a lot of discussion then, also on that panel with Australia, the UK, US, and just about all the discussion now has been on that as well. Pardon me. The main issue there is that there's a huge shortage of student housing in the major Canadian markets. What are your thoughts in terms of, given where else you've invested, what are your thoughts in terms of going into Canada in the same way?
I don't know anything about Canada, but I do know that their pension fund money is mostly in UK student accommodation. So I guess they probably are trying to find ways to put the same capital into their own country. If the supply and demand is there, it's an obvious investment. Just like Australian pension funds invest a high majority of their capital in multifamily in other countries, but Australia has no multifamily market for them to choose from. So it's kind of like the first demand of everyone wants to invest in it, even the pension holders, so give us the product, and then tax changes come. But as a sector, I don't know anything about it.
I see it in quite a similar sort of stage as Australia, relative infancy, huge potential, backed by great fundamentals of strong universities, great job market for graduates after that. And at the moment, it's in sort of that development phase of owner-operators being in the market and consolidating, so sort of lack of transaction and transparency. And we're seeing that sort of move to second stage in Australia. So it kind of expect that to come in Canada, but I think at this point, quite fragmented. But definitely, it's one of the markets that we see as a huge growth potential, but just not yet institutionalized.
Right. And so do you see most of the investment in that coming from more domestic players than it would be from foreign investment going into Canada?
I think starting to, but I think kind of what's going to change over the next kind of global student accommodation is going to stop being called alternative or specialist asset classes, and it's just known as an asset class in itself, which is really important. I think we're going to see the global players, like Scape and GSA, be truly global. At the moment we call them global investors, but really it's UK, Australia, US, and parts of Europe. So I think it's going to be driven by those groups that are kind of looking to be the first properly global player.
Yeah, and just to add, we're backers of Scape in Australia, and are well aware that they do have plans to enter the Canadian market. I think it's, the order of which markets they want to enter in first, right? Because they tackled UK, then they went to Australia, now also in US. I think it's just the size of the market. It's still relatively smaller than these three markets, which is the top three countries for foreign students. But I'm sure as and when, they've tackled those three, next would most likely be Canada.
Right. Yeah, because the dynamics in Canada are very similar to Australia. Now, there's a lot of similarities in many, many ways. Population size, key cities, and also in terms of migration of foreign students. going to those key universities as well.
Yeah, yeah,
So,
absolutely. It's almost slightly behind its time in terms of its dynamics. Will look really good, but it's just kind of the scalability at this point. But yeah, definitely something that we're looking as a next hotspot.
Great. Yep. I'll just come around to you.
Just wondering, are you guys doing anything to target Indian students, especially when you said there might be not a restriction, but the Chinese students not really going towards the US or the UK, but Indians are not only increasing in number, but also in your point on parents paying upfront. It's kind of the same culture even in India with students, the upfront customers at the end of the day.
Yeah, I can start. I mean, for sure, with our properties in Australia, as I said, Scape, who is our partner in Australia, they are diversifying the student base. Definitely, I think India is, if not second, third in terms of the allocation. But things like setting up a sales office in India, which is what they're trying to do now, as well as, as I mentioned at the start, curating the community aspect inside the property with events that are targeted for India students. That's all happening right now, which we definitely see India as growing in terms of student market.
Yeah, with our buildings and the markets we're in the UK, there's a very low proportion of Indian students. So we've had to be more targeted towards the Chinese students within those buildings or markets. But if there was a higher proportion of Indian students coming in, we would just create a targeted strategy for that. But I don't know what the numbers are for UK versus Australia for Indian students, but I feel like there'd be more Indian students in Australia probably.
I think more UK. I'm not sure, but it's huge growth in terms of Indian students coming out. But I think also backed by government initiatives who want to get 30% of 18 to 23-year-olds in higher education over the next few years, which is, if anything's backed by government initiatives like that, it's hugely attractive. But I think for overseas markets where they're already really benefiting, but also the domestic market of India as well, which we're expecting some big growth over the medium term.
I think in terms of our schemes, there's definitely a large pickup on student inquiries from Indian students, but we haven't actually seen them checking into the sites. And I think a lot of the Chinese students like the sort of the safety and the purpose-built nature of and then we've probably seen Indian students, some of them, the rich ones, some of them staying in purpose-built, and then a lot of other alternatives for them as well. Whereas if you look at Chinese as a profile, it's almost a lot of them are in the PPSAs.
Good. Hi guys, Edward Madden from Forum Partners. Had a quick question just around returns. So if we looked at a single project through from land acquisition to construction to commencing operations to ramping up to getting to stabilised levels, so let's call it, say, a 5 to 6 year period, what types of IRRs and multiples are we talking with sort of normal 50% gearing?
Yeah, you go 65% gearing, you go 20, 30% gross IRRs up to stabilisation. We wouldn't do it if it was below that. 50%, it's not too far off that. But I guess in the UK for student accommodation, the debt market's really liquid for the development and investment. So to give you context, development, you can get funding at sort of 6.5% on top of LIBOR, up to 65%. And then down to 50%, people will market to you that you can get 3.5 to 4% on top of LIBOR. But then you do the deal with the bank and realize there's a non-utilization fee, hidden costs and all this, and it grosses up somewhere around 5.5, 6% anyway. And you've got to do a guarantee and you've got to...
I hate those fees.
Exactly. They always come at the last minute, but that's kind of where that development market sits. But those development packages, because the market's so specialized now, there are many better options where you get sort of an all-in development, investment or permanent loan facility where you can develop for 2 years, automatically refis to an investment loan at somewhere around 4% fixed or 4% including LIBOR during sort of 2 to 3 years stabilization. So if you can tie in your debt really neatly, you can get sort of standard development returns and IRRs 20, maybe 40% if you've got a good developer. But if you stuff up on your costs, then you're back to zero.
Just to add, I mean, I think that's pretty healthy returns. I mean, what we're seeing, I guess it depends on location as well. In Australia, we've been targeting really close to the CBD, sites really close to CBD, because most of the universities in Sydney, Melbourne are right in the middle of CBD. What we've been seeing, mid-teens, maybe 15, 16% for development. But for, say, core income-producing assets, looking at high single digits, maybe close to 10% levered returns. But what we've seen is that's definitely coming down as more and more investors are looking into the sector. As Emily said, it's no longer a niche or alternative sector anymore. A lot of investors, like our peers, may not have looked at it 5 years ago, are now very eager to invest. So we definitely see the returns coming down.
And those returns should change too if you're doing I'm talking about traditional development, but if you're doing like a forward-funded model, which other institutions will do, that'll come right down because you're removing heaps of the risk. So then, if you're doing that, you should be expecting some sort of institutional 8 to 10% return. But you've funded all equity, you've got no debt, and you've kind of taken a reduced risk position. There are many more of those deals in the UK, but in Australia, I say the word forward funding and people look at me cross-eyed because it's not really a mechanism people are used to in Australia, but they will get used to because you did a
UK is
deal
very
for
common,
that.
and actually we're seeing a very little discount between a stabilised asset and a forward funding asset now.
Your Adelaide one was forward funded, right?
Melbourne deal we did was forward funded.
As an Australian, that's very weird.
Yeah,
Australians don't know what forward funding is. I do now.
it was a struggle to sell it.
I guess the other thing to add is, we've had a few schemes in London where the planning aspect has also uplifted the value because, the number of newly consented student schemes in London is almost non-existent because of all the competing uses of resi and commercial and so on. So existing schemes have had, I don't know whether you've had that experience, but we've seen some yields compressing just because they're in London. But I guess I'd also add that, when we talk about IRRs, there's IRR on paper where it's on valuation, and then the IRRs that you actually exit or transact, and these numbers I find them can be wide apart.
But I think with Scape's acquisitions in Australia now, a lot of the cap rates and a lot of development appraisals are probably being compressed, at least on paper, because in Australia there weren't enough transactions to really know where the market was until the deals you guys
Yeah,
did.
absolutely. I think as I said, there hasn't been a lot of transactions, partly because there's not enough product or stabilized product, but also I think partly because in the last 5 years, investors still thought this was a niche alternative sector. But yeah, the Scape transactions that we just recently closed and will be hopefully closing soon has definitely compressed the yields. However, I'd still think there's a healthy spread between PBSA versus some of the other core traditional sectors like office and retail, and also a spread comparing with, say, the markets in UK. I mean, cap rates, for instance, we're talking 5 to 6%, and my understanding in UK it's a lot tighter, right?
London we're sub 4 now. Prime regions sort of 5 to 6.
What were your Sydney assets?
Sydney assets were depends which ones, but tightest one's sub 4.5.
Same.
So we have one quick question.
We've seen the yields on a lot of the Scape stuff be published at about a 5, plus or minus. Sydney stuff a little lower. What are you seeing on the development side in Australia from a spread perspective, and where do you guys kind of going in at on the underwriting?
I think depends again location, but yield on cost probably looking at 78%. But yeah, as I said, one of the reasons 5 years ago when we were looking at that was north of 8%. But in the last 5 years, partly to do with the residential boom in a way, a lot of the developers were competing with our sites. So land values have definitely increased a lot, especially in Sydney. Very hard to do deals there. But that has come off a bit, as you might all know, in Australia, residential market has somewhat, for PBSA opportunities have started to come up again, and also a little bit to the same extent to hotels as well. Yeah.
But I think the debt market had an impact on that. Do you guys put debt on those projects, like with local Australian debt?
Yeah, development, we target 60% LTV. 5 years ago, traditional banks...
With recourse?
With recourse. Traditional banks, actually, when we first started looking at Scape 5 years ago, they weren't keen to lend. A lot of the banks were their first deals, but now I think it's a widely accepted asset class for banks, traditional banks.
Is that full recourse or partial?
Sorry?
Australia would be full recourse. Yeah, not sort of like interest costs or construction costs capped.
No partial available?
Probably now, yeah, not back then. Much different to US.
Right, I think we're out of time, but I'm sure we could squeeze one more question if anything's burning on someone's tongue. Nope. Excellent. Well, fantastic panel. Thank you all panelists.
Thank you.
I'm sure they're going to be